Welcome to Money Convos, where we discuss personal finance and investment tips. We're committed to helping people create wealth and achieve financial freedom. Follow us on Twitter, Instagram, Clubhouse, and Facebook, and subscribe to our YouTube and podcast. All right then, let's head into today's conversation.
Hi Adam, how you doing?
Elikem, I'm doing good. Yourself?
I'm great. I
Hello,
hope you can see that. I brought us a nice surprise. Our prodigal friend is back
Hey, Jenny has
for a
been
special episode.
Hi Adam, it's been a minute.
Yeah. Hope you're doing good.
I'm fine, thank you, and you?
I'm good.
Okay.
Before we come back to Jenny, Kwabna, I've invited you up so you can check your notifications or request the mic so we bring you up. So back to Jenny. Jenny, do you remember the last time you were on Money Convos?
I have a very vague idea, but I don't have specific dates.
Was that like 2020?
It's actually late last year or very early this year.
I don't. Did you do some of the the goals with us? Did you give us your goals?
No, so I gave my goals for last year, what I had achieved, but I didn't do goals for this year.
Okay. Then maybe it was last year that you. Okay, fine. Charlie, it's nice to have you back here. As you have come, we hope that you will stay. It's like
I stayed, yes.
church when you talk.
Yes.
Well, so today we're going to have an interesting conversation about the bank's losses. Banks in Ghana have recorded record losses for the 2022 financial year. It is bloody. And I then what do you see?
Charlie, Elikem, it's all red. red seas everywhere. It's not funny. It's not funny at all, Charlie. We are sure that we are hoping that they will pull through better this year.
Interesting.
Optimistic.
Cautiously, I like that word. Anyway, so to help us discuss this and understand what went on and think about what we as investors should be concerned about and what we should do, we have Jennifer joining us and Kopna also joining us. Hopefully, Serum and Mimi can also join and share their perspective on these things. But yeah, let's jump into it. Jennifer, so then tell us what has happened and what caused it.
So, the government of Ghana embarked, as we all know, the government is trying to get an IMF program of 3 billion Ghana cedis, and road to IMF is showing that we need to get our house in order, and for Ghana to be able to get its house in order, it needs to reduce its debt burden, and its debt burden shows how much it owes people or investors, and the amount of interest it needs to be paying on the loan, on the debt that it owes other people. And so because they needed to get this in a very tight space, they needed to do a debt exchange. So they did a local one, they'll do an external one. And the local debt exchange is the one that we heard a lot of news about, where they were exchanging the CD denominated bonds that they floated. And bonds, as we know, are debt instruments. So let's say the government wanted money some time ago. They said that give me your money for, let's say, 5 years. Every 6 months, I'll pay you interest on it. And then at the end of the 5 years, I'll give you your money back. So something like that is called the bond security. And they wanted their investors to bring back the old bonds that they had for new bonds. So that's why it was called the debt exchange. Bring back the older one that I have and then I've given you, and then let me give you a new one. So averagely, the interest on the older ones that they had were about, let's say, 19% averagely. But they wanted to reduce their interest. So the new ones they were going to give was, some of them were 10%, some of them were 15%. So let's say averagely about 12.5%. And this was to reduce their interest paying expenses, and then show the IMF that we were committed to getting our house in order, so that they can also give us the bailout. Now, the banks actually got the jury is out if the banks got a worse deal than any other category of clients. But what the banks got was that the banks will exchange their older securities. So, for instance, if I am Bank A and I had a bond that was, let's say, maturing in 2026, the government was saying that I should bring that my 2026 bond, and they were going to give me bonds. They will split. Let's say if it was 1 million, they will split that my 1 million bond that was maturing in 2026 into equal proportions. From that, they will pay me from 2027 until 2038. So every year they'll pay me something small on that 1 million. Every year something small on that 1 million. The interest they were going to pay is very fascinating. So, but I won't go into those details. But suffice to say that this is what caused the banks to have such a bad year last year, because now that they had to do this debt exchange, they they had quite a lot of money in the government securities. And so if they had to do something as drastic as this, where you are going to spread something that they had for so long, and they had to, by Bank of Ghana rules too, they had to do something we call impairments on securities like these. So for the terrain to change so drastically, they needed to also do a new impairment for the new bonds that they were going to take. And so they had such huge impairment losses in their books for 2022. An example of a bank had an impairment of as huge as 1.7 billion Ghana cedis. And this is like a provision. So you have to put down some money to the tune of, let's say, a percentage of the investments that you have, so that if anything happens, you have that money to help you out. That is what the impairment provisioning is. And so they had to do this for the last year books. And when you are doing impairment provisioning, it is against your revenue. So as you are doing that, then your profit is also reducing. So an example of this bank that I'm talking about, they started with a revenue of 2.8 billion, which means that at the end of the year, all the money they had gotten from their customers, interest that they have gotten from their securities and everything, and interest on loans that they had given to their customers, interest on overdrafts, everything that the bank did that in 2022, they got, sorry, pardon my background noise, they got income of 2.8 billion on it. And they had to do an impairment provisioning of 1.7 billion Ghana cedi. So you see, your costs of doing business hasn't come. If you got deposit from clients or customers, that's interest, small interest, and let's say even fixed deposit interest you pay to your clients haven't come. Your staff, what you pay them hasn't come. Utility costs, nothing else has come, but only the impairment provision is taking such a huge chunk of your money. So by the time you finish accounting for all of the other things, then sikanasa. So that's what happened. Impairment charge was quite huge, and when they added it to all the other expenses that they had to incur, take in mind that inflation was also quite high last year. So cost of living was also very, very high. When you add all of these things, they couldn't cope. So they posted a lot of losses. Even in this year, we've seen that there have been some recovery among certain banks, but a majority of them are still struggling to find their feet. I hope this, I didn't go into technically, and then if anybody else can add on, or yeah, thank you.
Okay, thank you, Jennifer. Thank you. So I just want to um, perhaps explain a term that you used, impairments, in my own words, and maybe Mamaki, you can, sorry, Kwabna, you can you can confirm if this is the understanding. Let's see if we can get lay people to understand this one. So it's like you are doing business, you've given out your maybe you sell tomatoes and you've given out maybe 1,000 cedis worth of tomatoes to somebody that who bought it for you on credit, who bought it from you on credit, and now that person, yeah, waiting for the money, and you realize that no, this person, the way it's going, the person can't bring me my entire 1,000 cedis. So maybe I only get 500 cedis. So what you do is you say that, well, that 500 cedis is lost. It's effectively lost. So you take it as an expense. You look at it as, instead of you selling it to get revenue, what happened was you made a loss on that, or you made a loss on that. So you treat it as an expense on your income statement, and then that reduces your profits. Am I capturing this concept of impairments properly?
Ellie,
Yeah.
yeah, I think so, but still a bit technical. Because I think
Mm.
what you were trying to do was layman's terms, so you were a
Hmm.
bit technical, yeah.
Yeah, yeah. Oh, really? Please, can you offer a more layman, a more layman
Yeah,
explanation for impairments?
a more layman explanation. Okay, so
And now you want to say that Sikano Ashi.
Sikanashi, but I'm trying to. So, like you see, like Jennifer tried to explain, your impairment comes from like your own asset, like your income. It's not coming from anywhere. Like you own the impairment, but whatever you're using to impair, like make the provision for impairment, you own. So in layman's term, if I come to you, Elikem, to give me funds for something, and then there's a risk that it can go bad, and I say, oh, the mamifa we enter in case it goes bad, this is what pays for it.
Okay. So they are setting aside the money now. It's not,
Yes.
it's not entirely just lost yet, but they are being careful, being cautious.
Yes, because what we need to understand is that like in as much as the government bonds are going to run for a while, like the repayment process is very slow and it will grind. Eventually, it will come back. I mean, if we are able to establish,
Oh,
yeah. So eventually, it's just going to take a while. It will drag out and stuff like that. But eventually, the banks are going to recoup. But now they have to record it.
okay. I get you. So the money is not lost entirely, but they are just being careful to say that you for now, let's set
Yeah.
aside
So,
this money.
yeah. For now, like
Okay.
because because they had the bond like the bonds on their books. They had them at amortized cost or whatever at certain point. Now the government is rolling everything back and giving everybody like they're giving you new bonds, new price and everything. So you've lost some sort of value. So we have to they need to record that now. So whatever is left, like we can't demand all of those monies that have been locked up for like maybe the next 10 to 15 years. They're not going to get on your books now. So it will if gradually it will come in. I don't know how they're going to be recording those when they keep coming in. If they're going to be putting them in interest income, I don't know, but it will come in gradually. Eventually, they'll get the money back.
Okay. Okay, that's good. At least it's so this gives some more understanding to people who may not have understood this. And I can imagine I'm looking at Paulina and I can imagine her nodding her head. Oh, okay. The understanding is coming. That's great. Okay, shout out to Paulina and Dennis in the audience and Mr. Beckley, ever so faithful to us. We really appreciate you here, Mr. Beckley. Shout out. And to our producer, Dennis, doing marvelous work in the background, making sure that our podcast keeps going out on time every time. Shout outs to you. Prince, how are you doing? Prince, are you there? I'm thinking about
Yeah,
going
look,
to
I'm
Prince.
fine.
Oh, wonderful. When Jennifer was explaining these things, it dawned on me that some months ago you were talking about a similar scenario going on in the insurance industry. Am I right?
Ellie, yes, please.
The man is weak. The man is weak. Hmm.
Yeah. So let me say for our industry to, we depend much more on investment income because we have we are quite if you look at the non-life, there are almost about 26 companies. Um, if you look at the life companies, they are also close to 23, right? And if I say investment income, it means that normally when we sell a policy, this policy, we promise people that we have the endowment, we have the risk product. So the endowment products are the product that have an investment component within it. And then the risk product are um, the product that is pure risk. So that one you buy, and if anything doesn't happen, you don't get anything out of the product. Good. So because we sell and this we sort of see it like an investment product as compared to we see the public seeing it as an insurance product. We have maturity dates to it. Yeah. So if you take a policy, an endowment policy, we can tell you that okay, the policy is going to run for let's say 5 years. At the end of the policy, you can come for your money. So when the whole issue of the debt exchange came to play, it became a worry for the insurance industry because one, uh, for sure, and most of the industry, our industry is dominated by a lot of the endowment products because a lot of people, when you sell insurance to them, because they don't have the understanding, they will always want to ask, what do I get in return? If I give you my money, what do I get in return? So endowment has become the number one sought product in the industry, which to me is a bad thing. We have another day to talk about it. So a lot of people take the endowment product and because they know that it will mature in 5 years, 6 years, they are quite expectant that when it matures, their money should be readily available for them. But here is the case: most of in the insurance industry, because it's being regulated by the government. The government give us directive as to how we apportion our investments that we do. So the premiums that we get, we invest so that we get returns to also make sure that when it gets to the maturity, we can get money to pay our policy holders. But here is the case that the, the government directive for insurance company, you need to invest close to 70% of your premiums in government securities. So in government securities, you are looking at bonds, you are looking at T-bills and other uh, uh, long-term bonds that the government issue. So within this period that this debt exchange came into play, now it's been a worry because now you have claims that you are going to be paid. You have the premiums coming are not quite enough. So we started experiencing issues with some companies not being able to fulfill their time turnaround time for claim payment because the money is not there. So you have to make sure you gather premiums that is coming from the marketing side to service some of these claims. And it's something that is a cause for concern in our industry because now the money is not there. So people are not even buying, the policy. And those who have even bought are coming to either surrender and you have to pay them something. Or some are also being going to mature and you have to pay something, which is also a bigger worry for us. But for us too, we also have we have a deposit. We have a deposit. So before you can start an insurance company, you need a minimum stated capital, right? So the stated capital, initially it was 15 million, and some years some discussions were going on that the government wanted to build robust insurance industry. So he decided to increase the stated capital to 50 million. But because of the debt exchange, the government has the regulator is saying that it has been held on for now. So as to when they are going to say that insurance companies should bring that 50 million, we don't know for now because they said because of the debt exchange, it's going to take some years before it can be brought back. So now most of them have a minimum deposit that uh, simply means that in case it gets to uh, the the last case scenario that an insurance company cannot fulfill its obligation to their policyholders and they are to come to a halt, exit from the market, the minimum deposit is what is going to be resort to pay um, the people that the insurance companies are owing before now the government can come in and bring other funds for the company to pay its debtors and then they can exit the business. So
I
that has
see.
been the issue.
That's interesting, Prince. And you bring out some themes that I really want to get into, like the role of the regulator in all of this, how different firms are being affected. There's where we can see from your example, like it's not it's cutting across all industries, as we say in our
Yeah,
local language, eboboba. Like it is rolling up. It's like a snowball that is turning into an avalanche, right?
yeah.
The most immediate place that I was felt was with mutual funds, investment houses. Now we are hearing from the banks. The banks, it was really low key and their customers didn't feel it, but now we are seeing it in these numbers, right? So let me switch back to Kwabna and ask about the people feeling this, right? I saw the numbers and it looks like it's not all banks that have been hit the same. I have an infographic here that summarized it really nicely. It looks like ABSA had the highest impairments, and Omni Basic had the lowest impairments. ABSA had 2.1 billion, and then Omni at 149 million. And at the time of receiving this information, three banks hadn't published. That's ADB, NIB, and UMB. So, do you have a sense of why different banks had different impairment amounts?
Okay, Ali.
Yeah.
Okay, all right, sure. So, okay, before I can get into that, then I need to um, start from a point. So, Jennifer talked about the I think Jennifer wrapped up the the government involvement, why this is happening. So, I'm going to take it from the bank's perspective, and then it will lead into your question. So, plainly put, the banks made bad investments. Because, I mean, the cardinal rule of investment, we all know, when you go anywhere and they're giving you high rates, you question where they're taking the money. Why are you giving such? Like, if the market rates are 18 and then somebody's telling you, I'll give you 30%, you need to question it. The banks took, like, cheap high rates from the government. At certain points, the bells should have rung that, like, it's risky. I mean, it's easy to say this after the fact because this has happened now, so everybody can say that they should have known. But that is exactly why the banks have their risk management departments and stuff like that to look out for these things. I think for some of the investment banks and the mutual funds, at some point, people they started to get skeptical with how the interest rates were going on the market. So some tried to get out of they tried to get out of government bonds. And so to come to your question, some of the banks saw it early. I think between second quarter, no, between the third and fourth quarter of last year, some of them tried getting rid of their government bonds. So I don't know if you've seen the financials for Societe like this. Societe really got rid of a lot of their government bonds. So they're one of the few banks to report profit at the end of the year. So why different banks were hit differently is because some held on to their bonds. Maybe it was difficult to offload them when, like, suddenly the entire market caught on to the fact that, look, nobody wants these bonds. The government will be defaulting. So now it became hard to sell. And I think it became a real problem when the investment banks started panicking when customers couldn't get their withdrawals and the banks wanted to sell at losses to even meet redemption requirements, then now everybody was not buying. So the banks that really had a lot of what's the name, government bonds, they had there was nothing they could do than hold to the end of the year and then start to book their losses. And then for some of the banks to, some of them, their main business, they were quite sort of open to expanding their loan books. They were giving loans to customers, businesses. Basically, the government bonds wasn't their core. They did some government bonds, but they also paid attention to their loan books. So the banks that actually paid attention to their loan books, they didn't have that much money with the government. But some of them are very risk averse because not long ago we came out of the financial sector cleanup. So there's still that skepticism in the market. Like nobody wants to risk their funds. They don't want, nobody wants to be the next UT, the next whatever. So people, they are quite safe, and everybody thinks the government cannot default. Last, they will print and pay you money. I think now they've shown everybody that we won't print and pay you money. So going forward, it's going to be very interesting. The banks, everybody needs to think. You can't just be lazy and give your money to the government anymore. So that's it. To your question.
I like how you finished. You can't be lazy and just give the money to the government anymore. You have to think and make the money work. That's interesting. And if I could get all of us thinking, not just the banks, everybody who has money to invest, you need to start thinking how you can invest the money. Now we've come to understand that concept of risk-free does not exist. There may be low risk, but there's always risk. All right. In fact, at this point, before I delve into some of the stuff that you said, I guess it will be a good time to remind our audience of what is the business of a bank. So you have deposits, or you have extra money in your pockets or under your pillow or somewhere, and then you want to invest it. So you go and put it in a bank. That means you've deposited there. The bank collects deposits from people who have extra money. Then the bank says, well, what do I do with all this money? I'm going to give it to people who want to take loans. So the bank does all the checks that they have to do and say, okay, this person wants to buy a car, I give them some. This person wants to do business, I give them some. This person wants to buy a house, I give them some. People who want to borrow money, the bank gives them loans. But then the bank also has other things that they can invest in. They can invest in bonds, other financial instruments, and the major one is the government of Ghana treasuries, the treasury bills and treasury bonds. And that's the portion that has come under fire now, and they're having to make impairments because the government has done a debt restructuring, which has cut down the value of these bonds, and then and extended how long it would take for them to get their money back. So they're having to make provision through impairments. They're having to put aside some money because they anticipate that it's possible there will be some losses down the road. So that's a bit on the business of banking and how it's led to here. So different banks had different strategies. Some were smart enough, or some saw it ahead of time. I don't even want to say smart enough because hindsight is 2020, like Kwabena said. Now we know better. But I'm curious, the banks that did well, Societe Generale, GT Bank, I see UBA and FBN, they did well in the sense that they didn't make losses, they were profitable. What are some of the things that they invested in besides loans? Is there anything else, or they just packed most of their money in loans? Jenny, do you have an answer before we come back to Kwabena?
Sorry, please repeat the question.
So, if not government treasuries, do you know what these banks that were in the green invested in, aside from loans, or did they do everything loans?
So they have loans, and then they also have some other debt instruments that may not be government of Ghana. So I've seen on Societe Generale that they have other debt instruments. They have 2 line items called debt instruments. So my guess is they may also be having, let's say, some corporate bonds in there that may not be necessarily government of Ghana.
Oh, okay. And I think some of the banks also lend to each other. So that may be another angle.
Yes. Yeah.
Yeah,
Yeah.
yeah. Kwamna, can you think of any other investments, or did
Yeah,
you observe any other investments?
I think that's what Jennifer just said. So,
Okay.
what we noticed was that, like, especially in the last quarter, they were moving their money from government of Ghana. One of the reasons why they actually posted profit, especially for CCT, that even though they had, like Jennifer just said, they had other forms of debt instrument that they were holding, their loans and everything. They got rid of a lot of the government bonds. So they, like, their impairment was also high, but because they had offloaded most of them, it didn't hit their bottom line like the banks that at the end of the year had a lot of government bonds. You understand? So moving away from that, like, and everything that Jennifer has just said, it holds. Like they expanded their loan books, and if you look at, they had other forms of debt instrument. They were not just looking at government alone. And I think, like you said, they were proactive in terms of looking ahead. And like I was saying, the banks have risk department. They need to be looking at these things, and I think they did that as society. They looked at it and they realized we need to be proactive and get out. And I mean, they couldn't get out of everything because at some point, everybody caught on, so nobody was buying any longer. So, but yeah.
Okay, cool. Jenny, you want to add on?
Not to this. There was something we're discussing earlier on that I wanted to weigh in about
Sure,
the
go
why
ahead.
the impairments are differing. So the banks, even though we have the Bank of Ghana has a prescribed way of doing impairments, there's discretion as to how you can go about it. And also when this came up, the Bank of Ghana gave them room that they have until 2025 to do the impairment provisioning on their books. But it looks as if they all decided to front load it, which means that they all decided to do it in 2022 instead of breaking it down. But I may be rushing the gun. It's possible that there's still more to come. Then they are breaking it down till 2025. But my what I want to say is that the discretion they have in provisioning is possibly impacting the amount they did. So it's possible that we are still going to see some for even people that we thought were standing good right now, but it's only because they provisioned less than, let's say, their counterparts are doing for the same level of exposure. So, for instance, Stanchart is a very conservative bank. They like provisioning. They like putting money aside for a rainy day. So if you tell them that, oh, put this thing there, before you realize they are putting all of their profit somewhere. So if you look at, let's say, their exposure to government securities, and then the level that they provisioned for, and you compare to, let's say, another company that doesn't have their history or the way they do business, you may think that, oh, that company is doing better. But it's because, let's say, Stanchart is very conservative and they are taking this opportunity to more than provision as compared to what other people are doing. I don't know if I make adequate sense.
Yeah, you do. I remember some years ago, uh, my CEO, my former COO, who is one of the most conservative people I know, was saying that I shouldn't buy. He was pushing back against when I was suggesting buying Stanchart shares. He said, no, they are too conservative. Now, if that man says that somebody is too conservative, that's a very big problem, because that's my chairman there. He doesn't like to spend money at all. Very conservative. So yeah, in terms of corporates, they do like to be conservative. If you recall, before the 2018 financial sector cleanup, they had, I think in 2016 or 2017, they had taken those hits. So when other banks were making losses or very little profits, they were bouncing back and they were fine. So yeah, that's their modus operandi. But it becomes an issue of who do you want to go with, the risk taker or the one who is ultra conservative. I guess there's a time for everything. But in these times, when things are hit the fan, I guess you rather lean on the one who was safe or more conservative. Okay, so let's start looking forward, because I was gonna ask this question and you've anticipated it, that could there be more losses in the future, or would there be a recovery? So you've kind of touched on it, but let me push you a little further. What will cause there to be a recovery in their performance, or can we start expecting that these banks should just be making losses over the next couple of years? And it's not just an issue of the impairment, right? I'm thinking if interest rates are low, how are they going to make it work? Any thoughts on that? Let's hear from Jenny first, and we ask Kwabna.
Okay, so the banks that are listed that I've had the pleasure of looking at their full financials, surprisingly, their loan book quality either remained the same or even improved, which means that the loans that they are having right now, the chance that they'll get those payments that people have promised them is quite high. And so there's not much problem with their loan book. So we can say that at least that part of their income is fine. So now the problem is their investment securities. I anticipate that from now, no bank will be adding on so much to their investment securities. And so even though I anticipate that the interests or the income they'll get from investment securities will fall possibly very drastically, I believe loan book should make up for that. And so we shouldn't see too drastic a change in interest income. The reason why I also say this is because now we've realized that a lot of Ghanaians are playing it safe. We've really been hit since 2020 until now. Like, we haven't had a breather. So everybody is just looking, where can I put my money that I can sleep at night and know that at least nothing is happening? And most of them are these big banks. So we've realized that customer deposits are growing very, very rapidly for them. Some of them very, very impressive performance. And so if this continues to be the norm, that means that they'll have quite some cash to be able to make more loans. And if they do this, then that's where my bravado that loan book growth or interest from loans will make up for the shortfall that we'll be having in investment securities come from. Thank you. Barring any unforeseen circumstance, let me put that caveat because we've really been through a lot.
Shaking my head. Now, there's Terry's paribus.
Jennifer Johnny Kalu.
Yeah. She's making all sorts of disclaimers over here. Okay, so that's what's influencing Jennifer's bravado. That's interest with barring any unforeseen circumstances. Perhaps interest income on loans can help fill up the hole. Kwabna, how about you? Do you have any additional views or perhaps a divergent view? Do you think the sky is falling?
I think I have similar views. I will pick on some of the things she said, and then I will move from there. So Jennifer said, well, we've been hit since 2020. Jennifer, it's been longer than that. We've been hit since
2018. Sorry, I forgot.
In fact, the whole financial industry has been hit left, right, center since 2017. So, like you said, there's like very little confidence in anything that is not very established. And again, that is why we see the bank, the deposits from customers in the bank growing, because like people now want to just keep their money with the tier 1 banks and just be safe. Like, they don't even want to risk any investment or whatever. Just keep my money for me. So as far as that goes, Ellie, like the banks are always going to get the cheap cost of funds. It's going to come. Their cost of funds is negligible. So they're always going to get the money to like go about their business. And like Jennifer said, nobody is eager to add on government securities anymore. So they are going to be looking at other investments to try and make up for the shortfall that will be in interest income, because again, a chunk of their funds, most of which they are impairing, are in government securities that are going to be paying peanuts over a very long period. So interest income should be challenged, but like Jennifer said, we expect that the interest that they'll be getting from opening their loan books and giving monies out to people would like cover for it, even if like you don't get back to like the levels prior to this whole DDEP thing. They will land in a region where it's close enough, and then they'll be good. So in terms of recovery, yes, they are going to recover. Even in Q1, some of the results that have come, not all of them, but some of them, they started showing Q1 profits. They're showing Q1 profits. A few of them are showing losses in Q1. So recovery, I'm not very worried about their recovery, except like Jennifer said, unless for some reason the government is able to dig themselves into a much bigger mess than like we already are in. If for some reason they are not able to land the IMF deal and like trust in the economy really dissipates, then we are in for a world of trouble. The other part is now that the banks will be looking at expanding their loan books, giving money out, like everybody is the people are looking for alternative investment. So loans to businesses, private equity, all those kind of things. They will have to be very careful, and their due diligence has to be top notch, because now, if anything at all, now is the time that they can make mistakes. Now is the time that they can make bad investments, like investments that will be locked up, investments that won't pay on time, and like it will just aggravate the whole situation. So I'm not worried about recovery. I think the banks will recover. They will be fine, barring if the government doesn't put us in any more trouble. But they will have to keep an eye on like the alternative investment that they'll be leveraging to like increase their or grow their interest income.
Okay, all right. So also, all things being equal, and as long as they stay on their best behavior. Okay, let's hope everyone keeps their best behavior. Speaking of people keeping their best behavior, so as we start to wrap up this conversation, what would you like investors to think? Let's start from an equity point of view, because a lot of these banks are listed on our Ghanaian stock exchange. So people have shares, and they may be wondering what's going to happen to that. Any thoughts on that? Jennifer, yes, Jennifer, you manage funds for rich people. So what are you telling your people? Hey, you
The
start
most
with
difficult
What are you telling them? You start with Jennifer, this is serious.
Elikem, the work, like I don't envy, and even though I'm there, I don't envy anybody who has to talk to clients about investments. And yes, I really don't envy. And everybody who is doing that here, I am like, you are a partner in arms, and I doff my hat off to you. Sarah Maya, continue to be doing your spa. That's the only way we can continue to be here. Anyway,
Jenny, I think on that note, maybe we should talk to the president to have a national investment advisors holiday. The way we have May Day, Labor Day, those things, so that we can celebrate them. Or in fact, we expand it. Anybody who does customer service work, anyone who has to deal with angry people, they deserve their holiday.
They really do.
Nurses who have to take insults from people, even though low-key they caused it, but it's okay, All
But
right,
they'll
all
say
right.
that we got Mayday, so we should all be happy about it. Anyway,
I
so
see, yeah.
the thing is that looking at the how investors are taking the news of the DDEP and its impact to the banks on the Ghana Stock Exchange, it is not very pleasant. The prices of the banking stocks are tanking. They are falling very drastically, and investors are looking elsewhere to other stocks that are not related to banks or government or DDP or anything to get some returns this year. If you're an investor and you already have banking stocks, I would just say that even though we are in quite turbulent times, and right now you are looking at capital losses on your holdings or your investments, you should just keep calm. don't rush and go and sell it off, because right now you see that they are booking a lot of losses, people are selling it off, and they are also not going to be paying dividend anytime soon in the foreseeable future. So you should just sell it off. I think that there are other stocks that are on the Ghana Stock Exchange, such as, let's say, Elikem's Baby, Benso Oil Palm Plantation, which is a palm oil refine producing company. So these companies have seen quite significant growth just in Q1 2023. So from January till March, even up till now, it has seen very, very significant growth. And so right now, I would say that the ship has sailed if you wanted to get in at very good prices, but you should monitor, hold, just be looking. You can still buy it now if you are looking at, if you have fresh funds that you want to invest in the stock market. This is a good name. You can also buy the banking stocks low while the prices are so low now. You can't believe that even Societe is about 62 pesos when it got to like one cedi 20 pesos last year. So yeah, you can buy it as they are low if you are looking at long-term growth. If you are looking at, let's say, the next 3-4 years, it's possible that they will still be recovering from the banking crisis. So my overall advice is keep calm. Don't panic. This is, even though it's a turbulence time, we don't expect it to be there in the long term. If you have banking stocks, keep it. Don't rush and sell it. If you have more and you have a long term, if you have money and you have a long term horizon, these are still quite good companies, just that they're going through short-term turbulences. So you can look at them, some of them that are good, and then continue. But if you are risk averse, you don't like risk, you don't like anything, I think you should be looking at preserving your capital in these times. Rather, just put it somewhere that you can rest better at night and have your peace of mind, because at the end of the day, peace of mind is better than returns. Thank you very much.
Thank you, Jenny. In fact, since you've mentioned specific stocks, do you want to issue any disclaimers?
Yes, I want to issue disclaimers. Don't take that as investment advice. I was going on and on. Do your own research before you go and buy any stock, please. Thank you. And the stock market isn't for the faint of heart. So know your risk level and everything before. And if you haven't bought stocks before, please don't use this to go and buy any stock. Please invest where you're already investing. Thank you.
Okay. All right. Thank you. Kwabna, before we even ask you, do you want to just say that all the disclaimers that Jennifer has made?
I was just going to say, Madam Disclaimer. Who Johnny?
So do those disclaimers also apply to you? Or you there? Yeah.
Ellie, you see that one fund that we used to tell everybody, this one that you can't lose money. So nowadays we are very careful, because what they what they disgrace all of us. All, like every investment advisor, like, what are you going to tell? Like Charlie, sometimes when the calls come through, it's Charlie anyway. So yes, please. All the disclaimers that Jennifer issued holds. They all hold for me. So getting into it, first of all, I don't think anybody should be panicking. Jennifer mentioned if you're risk averse, you should be looking to preserve your capital. If you are risk averse, you shouldn't be in equities to begin with. It's like she said, it's not for the faint of heart. Like your entire value could be wiped overnight. So if you're truly risk averse, it is not anywhere you should be to begin with. In terms of the bank stocks, yes, for now they are tanking because of the losses at the end of the year, and like any good stock market, it's responding to the information out there. So I'm not surprised. In terms of whether they'll be paying dividend anytime soon, I don't think this year we're going to see any dividends. I doubt it for next year. Maybe in the third year when things really turn around for them somehow, then we can start to see some positives there. What in terms of buying stocks? I mean, equity is a long, it's a long game. So if you're really somebody who wants to, you can, like Jennifer said, do your own research and pick up some of the stocks that are good but are tanking now, because eventually, look, some of these banks have very good fundamentals. So eventually they're going to bounce back, and when they do, you want to be in there when the price is coming up, so that when you're exiting, you can exit well. But like, if the banking sector is too risky for you now, you can look at some of the other stocks. And she mentioned Bob, that I mean, Jennifer, you're right, because now the price has already risen. It's looking like the people who are in, or people who already have it, have maximized, and then, but I feel like it will keep going. So I mean, you can still make some gains there, even dividends. So it's still not a bad buy. But all in all, like Jennifer said, look, do your own like research before, especially before buying equities. Talk to somebody, because the stock market can be very, very fickle. It can change within. There was a time where Fan Milk was very, very good. Like, it was a very good stock, and now the price is terrible. Like, so you can't sort of operate on past information or things you've heard. Oh, I hear this one is this, I hear this one is that. Do your own research and before you buy anything, especially on the stock market. And like Jennifer said, peace of mind is better than return. Jennifer, this you're saying, I'll keep it. I'll plagiarize it. Peace of mind is better than returns.
That's great.
Especially
Thank.
unrealized returns.
That's good. That's good stuff. So thank you, Jennifer and Kwabena, for giving us the state of the banking sector and some tips people should consider. I see, Prince, you have a question or some thoughts for our audience?
Yeah, so Eleke, I think
Mhm.
your speakers are too focused on equities. I think I will be quite happy if they can be broader on the investment vehicle, because I think within this period, equity is something that uh, maybe most of the callers here might not consider. So it would be very cool if they can also talk about other investment vehicles that they think that currently people can resort to. Thank you.
No, so Prince, on that, I think over time we've been talking generally about different kinds of investments. And these days, people are looking into real alternatives, anything aside from a financial institution, because the confidence has come down, right? I think people can start looking at real estate, but there are so many investments out there. I think the best thing that people can do in these times when there's turmoil, without us even making a list, is talk to a financial advisor. Seriously. Because when people are starting to run away from one end, they will take refuge anywhere. You don't want to be that kind of person. You want to make sure that where you take refuge is somewhere that you understand and you get somebody to explain it to you properly. So I just want to avoid that concern. However, something that's related is, we are talking about these banks and not everyone deals with these banks in terms of shares. So perhaps if we can briefly, just in a few sentences, Kwabna, I know I prepped you for this particular question, or I asked you to be aware of it if it may come up. What about people who have their deposits or fixed deposits in the banks? What should they do?
Okay. All right. So before I even talk about that, so his question about what other investments. So okay, so unfortunately, most of the mutual funds that we have in Ghana, in the country, are mainly they invest mainly in financial assets and mainly bonds. Some of them have some fixed incomes, like fixed deposits, corporate bonds in there, but they are mostly bonds. So if you want to avoid that, the pool becomes small for you. Maybe you have to look at REITs, like real estate investment trust. Investment like private equity and stuff like that may be out of your league because of the minimum like requirements to get into such investments. So barring the mutual funds, if you want to avoid the financial like assets, it becomes the pool of investments that you can look into becomes quite narrow. So yeah, there's that. In terms of the fixed deposit with the banks, like Jennifer and I have said like earlier on, the banks, FDs, they've expanded their loan books, they've given money to businesses and stuff like that, and the interest incomes that have come from that side have been more than enough to keep the banks, even though some of them made losses, they've been more than enough to keep them above levels where they will be in trouble. So I don't think their like fixed deposits are at any risk. The only thing that can put fixed deposits at risk now in my head will be the government. Like I said, the government putting us in a much serious position than we are in right now, or something happening for confidence to really deteriorate, and then people run on the bank. And that one, even without a banking crisis, when there's a run on you, you are done. So I don't think FDs will be a problem. But then again, for people who really look into fixed income, they'll have to do a lot of scoring to see where to take your funds and not. So again, like Ekem said, you have to talk to what's the name, an investment advisor. And if you want to do FDs, like an indicator should be the kind of rates that they are giving you. When you hear certain rates, you need to ask questions. And in fact, with every investment, you need to ask questions. But certain things should set off alarm, and then you have to ask questions.
Okay, thank you, Governor. So yeah, that pretty much covers it in terms of what else should you be looking at, and how should you even be thinking about the banks. Jenny, you want to add on to that, and then we can wrap it up.
Yes, please. So with the banks were really impacted by their amortization. Impairments, and their income, the revenue they get and casa hasn't been isn't what caused them to, let's say, get the losses in Q4 or 2022. So I'm thinking that if let's say you are an investor and you are thinking, hey, is it good for me to send my money to this bank or that bank? Then it is their ability to be able to generate revenue, to be able to even pay you, is what should be your concern. So if you're able to read financial statements, then you should be looking at what revenue they are able to generate as compared to what they are paying out to people that have given them the money for them to use. And that is the first and second lines that you see on their financial statements. So yeah, that's it. And as you said, because they are awash with cash right now, they're able to be a little flexible with these things. So currently, we don't think that there's going to be such a serious problem with fixed deposits. But another caution is that the situation is very fluid, very, very fluid. Something nobody would have thought that this is what will come as at October last year, just when they had published their September results. So things are very, very fluid, and something that we say today may not stand tomorrow. So keep yourself updated with everything that's going on. Know everything that's going on in the economy and how it affects your funds, so that you can be abreast and not be using very, very old information to be taking financial decisions. Yeah. Thank you.
Great, thank you, Jenny. So yeah, like she said, don't use old information, but if you are not on top of everything, keep coming back to Money Convos. We will update you, and follow us on Facebook, Instagram, and here on Twitter. Listen to all the conversations, or if you join this conversation, you can listen to it again here on our Twitter timeline or profile, or you can listen wherever you listen to podcasts or on YouTube. Just check just search for Money Convos, and you'll find it there. Shout out to Dennis again for making these things possible. Also, you want to check out Investment Friend on Instagram. They provide very good content. And you see, we are talking about ensuring that you are taking decisions that fit your interests, that fits to your circumstances, that a professional would would take all these things into account and advise you properly. A good way you can get such an interaction is get on Instagram, follow at investment_friend, where they offer more personalized financial advice. Here at Money Convos, we do more of the education. It's one-sided. We just tell you this how the information is, but sometimes your unique circumstances may not apply with what we are talking about. So do get on Instagram and follow. Tell people to do so, and we'll all be better for it in a few years. We hope that after all these discussions that we have in the next 5 years, when we all reconvene here, we'll go like, you know what, our lives were better off for listening to Money Convos and Investment Friend. So yeah, thank you all for spending your time, your weekend, your midweek with us. And I hope that you enjoy the rest of the week, make some money, be productive, and then we'll catch you here again next week, same time. Thank you so much and goodbye.
Bye, Ali.
Thank you, Governor. And Jennifer, we hope to see you again soon.
Yes, please. The prodigal daughter has returned.
Okay. All right. Bye.
Okay, toodles. Thank you for taking the time to listen to our thoughts. I hope you learned a thing or two and start practicing. Don't forget to follow us on Twitter, Instagram, Clubhouse, and Facebook. And subscribe to our YouTube and podcast. Do tell a friend about Money Convos so we all become wealthy together. Talk to you soon. Bye.